When you retire and stop working for the federal government, it doesn't necessarily mean that you stop paying income taxes. Federal income taxes are pretty clear cut, but state income taxes can be all across the board. In this video, we will highlight the best tax-friendly states for federal retirement income, and we'll also point out those states that can get a little more friendly. That's coming up, so stay tuned. Hey, welcome to the Money Briefing. My name is Jarrell Harvey and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you're new to our channel, please consider sharing and subscribing. Understanding your direct and indirect expenses are an important part of the retirement planning process, and taxes are a key consideration that sometimes can be overlooked. The way your retirement income is taxed on a federal level is pretty much similar for most federal retirees, but how your retirement income is taxed on a state level can vary widely. When I talk about retirement income for federal employees, I'm specifically referring to three main categories of income. And those categories are your first pension, Social Security, and your retirement investment accounts, which may include your TSP and any company-sponsored plans from previous employers, as well as your IRA accounts. On a federal level, most of your retirement income will be subject to federal income taxes. The one big exception includes distributions from Roth accounts. Federal income taxes on Roth contributions are paid before the contributions are made, so any contributions and investment gains can be withdrawn tax-free after 5 years if you have reached age 59 and a half. There are really three numbers that you should remember as it relates to federal income taxes on your retirement income. Those numbers are 100, 95, and 85. So 100% of your income from your traditional TSP and other traditional retirement accounts are usually taxable. Roughly 95% of your first retirement pension is taxed, but this number could be lower for some future retirees who became federally employed in 2013 or later based on their contributions into the retirement system. And the last number is 85% because most federal retirees will pay taxes on 85% of their Social Security income. So now that we've covered the federal side of the house, let's focus on the state side. The situation is more complex when it comes to how state taxes will tax your retirement income. Some states have no income tax at all, while some other states will exempt certain types of retirement income. When developing the list of most and least tax-friendly states, I evaluated all 50 states as well as the District of Columbia. I attempted to rank the states in different quartiles. In other words, the top quartile consists of 13 states. Then there are 25 states that fall into the middle section that make up the second and third quartile. And then the bottom quartile also consists of 13 states. I reviewed how the different states taxed each component of the three retirement income sources. Every state in the top quartile does not tax any portion of your retirement income. Therefore, you will not pay any state income taxes on your first pension, Social Security, or investment income. Those states are Alaska, Florida, Illinois, Iowa, which just recently jumped into the top range due to tax changes in 2023, Mississippi, Nevada, New Hampshire, Pennsylvania, South Dakota, Tennessee, Texas, Washington, and Wyoming. In this group, you have states in all parts of the country, including the Northeast, South, Southwest, Midwest, and Far West. There are also some states that fell just outside of the top group, but deserve an honorable mention, such as New York, which would not tax your first pension, Social Security, or TSP, but the state may levy some taxes on your non-federal investment accounts. Now, let's look at the states that fall into the bottom range. Each one of these states will levy some form of tax on your pension, Social Security, and investment income. The states are Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, North Dakota, Rhode Island, Utah, Vermont, and West Virginia. Even though state taxes are an important factor, they are not the end all be all when considering a state as a living option. Other cost of living variables such as home prices, property taxes, and other forms of taxes and fees could have a significant impact on your financial well-being. State laws could also change as new leaders come into office, so some states in the lower part of the ranking could become more favorable over time. Additionally, family and climate conditions could play a role in where you decide to call your home. If you're considering moving to a new state, or if you spend time in 2 or more states, then you'll want to become familiar with the state residency rules. Similar to state taxes, most states have their own rules for determining residency. They consider factors such as the amount of time you spend in each state, where your primary residence is located, and where you hold a driver's license or voter registration. Generally speaking, you're considered a resident of the state where you maintain your permanent residence and where you spend 183 days or more, which is half of the tax year. But some retirees with a second home in another state could possibly get caught in the trap of dual residency and dual taxation. So again, you'll want to review any residency requirements or exemptions. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you have any comments or questions about federal benefits or retirement planning, you can add them down in the comment section below, or you can contact us by visiting our website at www.fedwayfinancial.com. Thank you for watching, and we'll see you on the next Money Briefing.